Okay, this is 2 p.m. streaming live, and I just want, as usual, to know if you guys can hear me. No, that's the main thing. If sound is coming through, I will appreciate that. Let's see. So let's wait a little bit until everyone comes, no, and see if people join so far. Okay, I have the first confirmation. I don't know why it's not showing me the number of people joining, but anyway, I'm going to start right away, or let's give them a couple more minutes, so we don't miss the beginning of the presentation. Let's put this thing here. Okay, we have 10 people. We can start with 10 people now. Welcome to the live video for the Gamma Optimizer room for May. I think this is the first time we do back-to-back. No, I usually do one every 3 months. So this is the first time we do one just a month after the previous one. And I guess there is a good excuse with all the market action we have seen for the last several days, for the last week and this week. So let's dig into this right away. I'll talk a little bit. You can type your questions. I'll come back to the questions. I'll break every few minutes and check some questions. So let's start with the NNDLA, no, which is kind of the start of the Gamma Optimizer room for now. If you notice, let's look at here at the variance center. If you notice the NDLA right here, I know that the mouse doesn't show in this particular broadcaster, but so for the last month we have had 3 positive signals so far, and all of them have been false. There has been false positive. So the precision of the NDLA is down to 0 again. You know, what a fall from 100% to 0. That's expected actually during a market dislocation. And the good thing is, because of the full system that we used, kept us out of the market during those 3 false signals. So even though we have positive signals that are false, we didn't trade them. So to us, it's the same thing. I guess I should have a different table. I like to have this table just to keep us honest, you know. But I have another table when I use the extra parameter of the cost of the spread less than 2.0. So that one works really well. The precision is much higher. So that's so far about the NDLA terrible, which is expected after market dislocation. And the same thing happened back in October 2018 and back in February 2018, and so we were prepared for this. Now, looking at the positions, we opened one position yesterday, this one right here, and that NDLA trade, suffice to say, is performing tremendously well. I mean, 62%, 64%. Well, it changes real time now. In one day, come on, guys, this is a fantastic trade. This is one of those moments like everyone wishes that, oh, I should have gone all in on this trade. No, this is kind of the moment. But remember, it could have been 0% or minus 100%. So it's better to have a systematic approach to this and be disciplined in terms of the size that we're using for the positions. But so far, the trade looks really good. Also, in terms of the second trade, is right here at the limit. I think there is a good chance for a second trade today. As usual, because today is Thursday, we usually don't have Thursday expiration. So the interesting thing is next week, I think, it's not next week, it's the one after that. So okay, forget about that. So anyway, so we have to use Friday expirations. And that's what is keeping the cost a little higher on the spread, but it's doable. I think I'll play a signal today as well. So we have a potential trade today, so just be on the lookout for my trade notifications. And as you notice, they are a little hectic because they arrive just before the close. But remember, with SPX options, we have until 4:15 p.m. to complete the trade. So it should not be an issue for any of us once I said the things. Okay, so everyone is saying hello. So I have some questions. Let me answer a couple questions at this point. Peter says that if I thought we will get a 100-point decline before thinking, will it be responsible to open opposite order? Well, yeah, I mean, I don't know where is the best time to open positions. Imagine that you think the market is going up or going down, and the question is always, what should I open first? Should I open first the trade that plays the down move, or should I open first the trade that plays the upside move? The answer is, I don't have an answer. You have to decide for yourself. So in my case, it's all based in cost. In my case, I look at the cost of the trade. I say, okay, is this risk reward good for me? Is price at such a point where I feel comfortable risking the money? And if it satisfies my risk reward, I open the position. I don't care. I mean, if it's a position for a longer term, then I open it. And that's one of the reasons we are carrying this September butterfly in SPX. It's actually break even. It's a fantastic thing. The market has been up, down, and this thing is just right there. I like it a lot because if something happens, if the world ends, this position will make so much money. It's unbelievable. It will probably tag $10. So I just keep it there as insurance for anything else that I'm doing. Now that's kind of what I do. Okay, let's see what else I have here. I have another some questions that I receive consistently is, okay, so we have an old signal. Should we add to the positions? I mean, if like right now, should we add to the positions from yesterday? The answer is no, of course. You don't want to add to the position if it's more expensive. But the answer will be yes. In general, if the original signal, when the original signal was generated, the cost of the spread was less than 2.0. That means it was a green. Now we have a green light for the trade. Yes, you could open it anytime. And in fact, I have done trades like that. I have done trades where I open a signal that will expire the next day and I spend 20 cents on it. I mean, the risk reward is too much to let it pass. So I will say, yes, it should be good to catch up with all signals if when the signals were generated, the spread was less than 2.0. So in this case, for instance, I don't want to play catch up with the signals from yesterday, from the day before yesterday, which the spread was a little higher. No? Okay, let's check if we have more questions. So Jim, of course, it's a great question. There is a reason. Jim asks, okay, we have the limit, which we have had the limit forever and ever. Remember that I actually bumped the limit up. The original limit was 1.5, and we bumped the limit to 2.0. So the limit has been always present in the NDLA strategy now. So Jim is asking, okay, we have a limit. Why not use the limit as a parameter to the neural net and let the net do the magic thing? And that's a fantastic question. And the reason is the only reason I didn't do it is because I am too lazy to do it. Because even though I have databases with the price of options going back to the beginning of times, the problem is when I construct the spread and when I want to price it, that operation takes a certain amount of time in my servers, and you will not believe the amount of time it takes. I mean, just to generate a data set with prices on the way back to 2018, it takes like an hour. No, it's like my database is tremendously inefficient querying these things. And so imagine now training the NDLA that goes all the way back to, well, the original NDLA goes all the way back to, I think, 2012, 2013, I don't remember. It will take forever, and I don't want to do it. I'm just lazy, Jim. Sorry about that. But if you have a database and if you have the time, I guess that's a worth thing pursuing. I mean, training the NDLA with that. Rafa asks why don't do a butterfly with the NDLA. Like, the reason is because the NDLA is not about where price will be. It doesn't tell us that price will be around an area. Price can just overshoot and pass through the 1%. And most of the time, that's what happens. Most of the time, even though the NDLA predicts 1%, we get 2 or 3%. So if we use a butterfly, we'll be losing money. The butterfly only works if you guarantee the price will be around the value of the butterfly. So that's why we don't use a butterfly here. Okay, so That's it. Let's keep moving to this. Those were prepared questions. The Kelly criterion. This is kind of the question. This seems to be like, this is the big question, like how to size trades for the NDLA or for anything in particular. So I posted something on the room early on today, and the question is, okay, how do you determine the correct size? And as well, this problem has been solved long ago for one of my colleagues. I say colleague, I mean, he died before I joined the company, but he was at Bell Labs as well. Kelly, I think he was John Kelly, I forgot his name. But anyway, the Kelly criterion, this guy did a tremendous work of devising a system where you could design the optimal size for your portfolio to play a particular strategy without going broke while maximizing the profits. You know, that's kind of the dream come true. And the funny thing is that it is so simple. It's right here. It's the first question. It's the first thing here. This is the Kelly criterion. It's just a little formula. And the fraction of the portfolio is BP minus Q divided B. Yeah? So what is B? The B is the payoff. So let's say it's for each dollar that I play, they pay me 2, so B is 2. No? Or if for each dollar that I invest, they pay me 3, B is 1. Or if it's even money, for each dollar that I invest, they pay me 1, then B is 1. No? That's B. Very simple. Probability of winning is that, the probability of winning on the trade. It could be defined externally, or in the case of the NDLA, is easily defined. And Q is probability of losing. So right there, I present to you, without further ado, the Kelly criterion. Just use it to your heart's content to size this. This is actually used in real life. This is used at professional outfits. And just I'm not going to leave it there. I'm going to use it for the NDLA. Okay? So let's plug some numbers from the NDLA here about what Kelly says. So in the case of the NDLA system, the full system using the limit of 2.0 limit has a precision, a 1-year precision of about 70%. So doing what every rational person in finance do, we assume that the NDLA is going to perform like that the next year. So let's imagine that the NDLA is going to perform at 70% precision, so P is 0.7. Therefore, Q is 0.3 because that's what it is. No, it's the complement of 0.7, 1 minus 0.7. And then B depends. It fluctuates a lot. So I'm using 2.7, but you can use 2.5. You can use whatever you want, I guess. No, you can use, okay, I should have used 1.7. But anyway, it will give you a very similar number. So it gives, if you plug these numbers, it gives you around 58%. But I think I'm more conservative. It's always around 50%. So according to Kelly, we should be using half of our portion playing the NDLA. And the first thing I told you, please don't do that. I mean, don't use half of your portion playing the NDLA. No, but at least that's what Kelly does. And I wanted to show an example about how the Kelly criterion works. I prefer to use a way more conservative approach because for me, the NDLA is not my only source of it's not the only thing I play. No, I don't play the NDLA. I do many more things. The NDLA is just a fraction of my total portfolio. So my first recommendation is please don't use the NDLA don't stake your fortune on the NDLA. Don't play your retirement money on this thing, and also don't play 50% of it on it. No, so that's kind of my recommendations about this. Let's see if I have some questions about the Kelly criterion. No questions so far. Okay. With this out of the way, let's take a look at volatility. No? So as you can see, if you remember, you have great memories from April, all of these values in April were around like 7% or around 9%. There was no volatility, and I remember specifically saying in the video that, man, I would love to see some volatility, and yes, we got it. We got tremendous amount of volatility. For the past week, it's around 23.45%. That's a gigantic amount of volatility, in particular when we came from a regime that was around 6 or 5%. So clearly the market went crazy for last week. For the last 2 weeks, it's been okay, almost 19%, and the last month is barely a blip. No, 13% is volatile, but it's not like we are entering into like, man, the market is breaking down. Not yet so far. Okay, so the market is still for the past month, the market is still chugging along, a little volatility, like speed bump in volatility, but it hasn't broken. No, it hasn't broken yet. I mean, if we see like 20% here and the W is 20 or higher than 20%, then truly we are in a completely different regime. So far the regime hasn't changed. So just keep perspective, folks. Keep the as they say, the forest from the trees. No, so right now the forest is telling us that yes, there is some volatility, but not quite. But if we see these kind of values slowly percolating through the WS20, then we should worry. Okay. And looking at VIX and VIX 90, it is a little high, not that much, 1529, 1487. The best play last week was a short-term volatility. That was the best way possible thing, and I didn't do it. I mean, I don't know. I don't want to short volatility lately for some reason, but that's the best play. It came down substantially from the highs. So that's kind of the volatility. So what are my thoughts about going forward with volatility? Well, I think we are in a period where it will start kicking higher. That's the reason I have the butterfly for September. The reason I have the butterfly for September is because I am counting on a volatility event. I'm counting on something happening, a miscalculation in some place, some kind of geopolitical error. I don't even know what it is, but I'm counting on that fly hitting 10. No, that's that. So there is a lot of potential volatility, but in the meantime, we'll play the NDLA week after week. We'll play it until it doesn't work anymore. No. What else do I have? Look at current positions. So let me check questions just in case I have more questions. Jim is saying most people do fractional. Kelly, that's very smart, Jim. Of course, Kelly. I will say that Kelly is too optimistic now. Better to use fractional Kelly. Okay, so the NDLA, as I mentioned, looks fantastic. Let's see here. Yeah, the NDLA looks too good. I mean, $3 already. Wow, man, that's a lot of money. The butterfly for September is a champ. I love it. It really doesn't matter what the market does. No? We saw it around 45, 50 cents a few days ago when we had volatility, but that's not the reason I have it. I don't want to close it at just 20% or 40%. I want to close it at 1,000%. No, just please remember, this butterfly will do amazingly well in a volatility explosion. It has a tremendous amount of skew into it, and it has a tremendous amount of Vega component. It's long Vega right now, believe it or not. So this is the kind of flies that I love. No? So we'll see. My current positions are good. The close positions, well, it's okay. We are returning 220%. Not proud of it, but not disappointed. It's a decent return so far on what we've been tracking since March. So far doing well. And what else? Q&A. Please ask questions, folks. Any questions that you have, just let me know. That's the whole point of doing this live video, so we can go over these things, so we can discuss, and I have a little bit more interaction with you. So Sam is asking me, have you looked at adjusting the two limit based on the performance? Okay, so, well, very good questions. Right now is the 2.0 limit is actually, well, it's based on the edge. I'm trying to get some edge out of it. If you really perform the calculation for positive edge, you will notice that the cost of the spread, the theoretical cost of the spread will be 3.5. Now 3.5 will be the fair price for an edge, but I don't want to trade at fair. I mean, I don't want to do trades so I could make zero at the end. No? So I want to extract good edge from it, and I think 2.0 is a good way of extracting edge. But there is also another quality about 2.0. One of the qualities about 2.0 is that it does a much better job than, for instance, VIX 9D of telling us when the market is having a volatility crisis, like somehow when the market is dislocated. So the problem is the NDLA algorithm uses VIX 9D as an input, and as Jim suggested, actually use the spread instead. No, So clearly VIX90 is a very poor proxy for it, while the price of the spread is a much better proxy. So I think 2.0 from the statistical analysis I ran, 2.0 is right there, is the point. Well, actually it's like 2.1, no. But I use 2.0 because we will never even, I mean, if we see 2.0, it will cost us 2.05. You have always to sweeten the bid to get the trade. So yeah, it's around 2.1 is the limit, and so I don't have plans to increase it. With respect to NDLA 2.0, I'm about to ditch it. I mean, if you notice, NDLA and NDLA 2.0 have been in synchrony most of the time. The only difference was here in May 10, and I think the NDLA 2.0 did a better job than NDLA Classic, but most of the time I don't see it adding so much value yet. So I am still keeping on it. I don't know. I think I like NDLA better. I might ditch NDLA 2.0. I come out with something completely different. No, like why? What is the point? I mean, if the whole algorithm is performing so well, why mess with it? And why start experimenting again? No, the problem with NDLA 2.0 is that we have to start from scratch. But right now, I like it side by side. It's kind of an extra confirmation. But again, no plans to bump the limit right now. Ray says that the September put butterfly appears to be holding its value and a nice hedge if the market sells for some reason. That's correct, Ray. That's the reason I have it. That butterfly is a very interesting little guy. You know? For those of you that can actually model this with a full simulator, you will notice that that butterfly has a lot of interesting characteristics. One is that the butterfly is actually long gamma, and it's actually long vega too. It's a fantastic thing now. It's like long gamma, long vega, but theta time decay is 0. If you notice, it has almost no time decay, and it is one of those things. It's one of those oddities that are present in SPX index. Sometimes you can find these kind of things. Once in a blue moon, you can find something like that. Don't count on it, but I'm happy with it. And if the market breaks down, this thing is going to make us famous, I guess. If the market breaks down, this butterfly is going to give so much money that will be unbelievable. So keeping it there, I don't mind 35 cents. I mean, I don't care if I lose 35 cents. Even a scale for the amount of contracts that I do. Jim says that, Michael says, where can we find the strikes for the September butterfly? Michael, the only thing you have to do is click on the link. If you click on the link, it will show you the full thing, the full with all the strikes, with the prices, the theoretical things. It tells you, it takes you to the right thing. So just click on the link, and it will, jump into what the trade notification was. Let's see what other question. Jim says that NDLA performs better than NDLA when VIX futures are in backwardation. Well, Jim, I take your word for it. I haven't tested. I think that's an interesting observation to keep in mind. It could be true. I saw it on May 10. I noticed when NDLA generated this negative signal and NDLA Classic generated this positive signal, just barely positive, I could see that the signal that it was being very sensitive to VIX being really up. But I don't know if it was sensitive to VIX really being up or VIX90 substantially higher than VIX, because there was a magical level where VIX was coming up and down, where the signal was changing from negative to positive. It was very, very interesting. So it could be. That's why I'm keeping it there. I'm keeping it there because I am a scientist and this is my pet project I like to study. And something else, folks? I mean, anything else? There's only a few more minutes before the half an hour mark, and I like to keep these videos really short. So hopefully it was entertaining and informative. And hopefully I addressed the questions that you were having, and we'll see. We'll see how everything plays out. Oh, something important I want to mention is that the NDLA trade that we have has a stop. I decided to add a stop. One of the reasons I decided to add a stop is because of you guys. You have been really good at taking my data sets, which I don't mind sharing with the rest of the world. There are no secrets on the data sets now. Those are results. So one of the findings that I found, very curious finding, is all of these findings about the partial precision. When the signal hits, then there is a high probability of the NDLA also completing. So now that we actually hit the target, in fact we are just hitting the target here in real time while I talk, I think that there is no point in losing money on the trade. So a lesson to all of you: if we are making money on a trade, we are making 67% on a trade, there is no point in losing money on a trade. I mean, if I am a trader and I go from being up 67% to being down 100%, I am the worst trader in the universe. So I suggest to you just to have a break-even. I mean, there is no excuse to lose money on this NDLA trade. I mean, that's the only thing I am telling you. Every one of you manage the trade. I manage my own trades, but in this case, please, okay, there is no point on losing money. So at least in your mind, keep a mental stop for break-even, or just a little bit higher than break-even. If the market starts to show weakness, then prepare and collect some profits. Now I'll keep it there until next week, but I am writing this in a higher size than usual, so I'll be really careful. And that's it. I think that's Lori says, when I joined the service, the butterfly was the first trade and I went in with a very small position. We just said, oh, of course, Lori. I mean, that butterfly is fantastic. Just think about the butterfly as an end of the world hedge. So don't think about this butterfly as something that can make a lot of money to you. Think about it as something that you could have in your portfolio, that if something catastrophic happens, it will light up. It will give you happiness. Provide you with joy. But I am not counting on this butterfly to actually making a lot of money. I'm just having it there just in case, because I usually net long the market. So I like to have this hedge with me. Brian says, where can we see the NDLA historical data? Well, Brian, there are a couple of places. The first place is this one. You can see the statistics from the past 180 sessions, which is the equivalent to the past 9 months. You can see the precision of the NDLA, the full precision, the partial precision, recall, the number of signals generated. So you can see right now for the last month is terrible. But it has been improving. And also I share data sets with you guys. So if you search all posts, you could find data sets for like more detail, like CSV files that you can open with Excel and you can play with it. So if you want something like that, just post in the room, let me know one thing in particular you want to know. Oh, and one more thing, like Steve Jobs before leaving. If you pay attention to the gamma imbalance, this is the gamma imbalance right here. There are a couple of things that jump right at your face. First is like gigantic gamma imbalance, like 25 billion. I mean, we never see gamma imbalance this high. And where it is, this gamma imbalance? 2,900. So right here, I am going to burn karma, and I am going to just do this wordless prediction that the market is very likely that will open tomorrow at 9:30 a.m. at exactly that value, 2,900. I mean, exactly that value. The reason is that we have monthly expiration of XPX options tomorrow at 9:30 a.m. So the amount of gamma in those calls is so gigantic that option dealers want to sleep tonight. I am telling you, they want to sleep tonight. Whatever happens overnight, these guys will have to hedge. And it's going to be a very interesting session tonight in the futures, and it's very likely the market will gravitate to 2,900. We'll see. I'm just burning karma. I don't plan to act on it. And please don't design any trades. This is just kind of a factoid, just for fun. Okay, can you explain the live trade that you are posting on Geo Variance Center? What live trade, Ray? You mean the NDLA trade? I don't know. I don't understand the question, Ryan. We can follow up in the room if you want. So just Ray, sorry, Ray. You can ask me in private or post, and I'll follow up there. Okay, folks, we have half an hour already, so that's it for me. And any other question will follow up in the room. Thank you again for joining. Hopefully everyone is having a good time, good trading, and remember, don't let profits evaporate. Don't never lose money after being up so much. Take care, folks.